The US economy is forecast to have grown 3.3% in the third quarter, but can it sustain that momentum? A clutch of US economic data that was delayed by October's shutdown is finally out this Tuesday. The headline will be GDP, which is forecast to show the US economy growing at a healthy rate in the third quarter. But that data is now pretty old. We're now towards the end of the crucial fourth quarter, so as Americans finish their last-minute Christmas shopping, will it be a Merry Christmas for businesses and the stock market? Kathleen Brooks is Research Director at XTB. Kathleen, this GDP number will make market headlines today, but when it's this old, does it really tell traders much that is useful?
I think you make a good point. It is very old data, but because we've had such a dearth of data, I think that the markets will react to what's coming out. This was meant to be incredibly strong quarter, which really says something about the environment that we're in right now, and you can project that into the future. So, for example, it shows that the US economy is very resilient to tariffs, for example, and geopolitical tensions and trade tensions. That it really has a resilience to that. Now, obviously, when we look at the fourth quarter, we're expecting a 3.3% rate in the third quarter, and then for it to shoot right down because of the government shutdown. So again, we're looking ahead to a very volatile period for US economic growth. But overall, nothing is flashing red for us. We see a strong consumer. We've had very strong corporate results for the third quarter. We expect that to continue into the fourth quarter. We haven't seen, inflation is moderating at a relatively decent pace. There's no concerns about inflation, and the Federal Reserve is cutting interest rates. So I think those things are really, really powerful, and that's what's helping to drive the economy. And obviously, as we look towards 2026, we've got potentially fiscal loosening in the US, so it could just be another driver of growth.
Affordability, though, has been a real buzzword in the US in recent months. Why aren't you concerned about US consumers starting to struggle, particularly at the lower end?
Affordability has been a real problem for years, I would say, for most of this decade, and the US consumer has managed to pull through that. The main reason why we're not concerned about it is because the unemployment rate is low. And even though it's a little bit volatile at the moment because of the shutdown and the delayed data, we think that it will stay, well below 5.5% for the long term. We don't see it spiking higher. Corporations are, they're expanding, businesses are expanding. Yes, we've got AI, which is a bit of an issue, but, hopefully that will give us productivity gains, not a higher unemployment rate. So because unemployment remains stable, because wage growth remains stable, that's where we see the consumer doing well. Yes, there are some struggles at the short end, and we've got this kind of K-shaped growth, which people keep talking about. So the high-end consumers just flying ahead and lower-end consumers are struggling. But I think the fact that unemployment remains very low and stable in the US, that really is the key thing for growth for us and for consumption.
Looking back on the year, Kathleen, it almost seems like April's tariff panic never happened, and the market has been shrugging off all this talk of an AI bubble. Can this mood carry on?
Yeah, yes, in a word, because we've had loads of boulders thrown at it, and it's continued to march higher. Look, the fact that you've got, the fact that you've got equities moving higher, but what we've seen in the last few months, obviously we've had precious metals moving higher, but we've also seen, industrial type metals moving higher as well. That doesn't happen unless we've got a strong financial system, unless we've got, a decent economic outlook. So I think the signs, the lead indicators are suggesting that all is good in the world's largest economy, and that is obviously good news for stocks. Also, we've got a good economy, and the Fed is cutting rates, and they're expected to continue cutting rates next year, not at quite the fast pace that we've seen this year, but they'll have a delayed effect. So that really is that's powerful stuff for stock markets.
Investors do seem to be taking some very bullish positions going into 2026. We see that across the market, from soaring volumes of corporate debt to private credit markets. Is all this optimism justified? What risks should investors also be looking out for?
Obviously you've got to be on the lookout, and there will be bouts of volatility in 2026 like we saw in 2025. That's largely been caused by politics, not actually by anything that's truly wrong with the economy. There have been concerns, of course, with private credit, but I think some of those concerns very much got blown out of proportion. First Brands, when they collapsed, that was very manageable and very small, and the losses there, and in that ilk of companies that went under at the same time, they're very manageable. They can be absorbed very, very easily. We don't see it as being a part of a broader problem. Right now, there is demand. There's a huge demand for, assets of all kinds, be it precious metals, be it equities, be it emerging market equities. We've got, private credit, as you mentioned, and debt in all its forms. So, we've got to trust that the banks and the investors are doing their due diligence. But as long as they are, right now, there are no signs flashing red to say that they should really hold back.
And with Kathleen Brooks of XTB, don't forget you can watch more videos on Reuters.com.